Good morning, good afternoon, and good evening, depending where you are on the planet. And TGI Friday. Welcome to the TGI. Thank God it's Friday, the 19th of May. Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. Now, I have had some issues with microphone in here just recently. So I'm hoping that you can hear me. If at any point, so if people are on live right now, if you're listening to this live, and incidentally, I do post this onto YouTube. So if you're listening on YouTube, remember, guys, that when I ask you questions on YouTube, I'm not live, right? It's not live on YouTube. So you don't need to answer any questions on YouTube. I'm getting we get some responses on YouTube, but no questions. And I'm not live on YouTube, right? It's just a posting of the recording. So just to say that. But if I do cut out at any point in here, can I just get a yes that you can hear me if you're live on at the moment? And then secondly, if I do cut out at any point and you can't hear me, please do type into the chat, okay? So let's do a look back and a look forward, what we've had, what we've got coming up, articles from the major news wires, quick look at the markets. A big bullish breakout yesterday, being fueled by hopes more than anything, but I mean, well-founded hopes that the debt ceiling talks are going well. We'll talk about that. But also, though, that was all in despite of, which I think went under the radar, some relatively hawkish comments from central bank speakers, and also a shift on the CME on the rate side. We're seeing a definite shift of the market moving towards the Fed rather than the Fed moving towards the market. If anything, the Fed yesterday took a step to slightly more hawkish, even the more dovish members, and I'm going to talk about that. And then we had the curve reacting, the interest rate curve. So we've definitely seen a shift towards a more dovish tone. A more hawkish tone, or a more hawkish expectation from the Fed, a slight move, and then quite a big step by the market to move towards the Fed, because we've been discussing, there is a big gap between what the Fed are telling us and what the market's expecting for the second half of this year. And I will look at that as well as we go forward. So we've got it's all about the Fed speakers today. Williams, Bowman, and then Powell speaking. So Williams 8:45, Bowman at 9, and Powell speaking at 11. Probably the big focus on Powell. We also have G7 going on today, and I think going on into tomorrow, into the weekend. We might get something out of that. Undoubtedly we won't. It's going to be very much focused on the Ukraine-Russia story. But in here, don't forget, we're going to come back to the Hawk Dove sheet in here in a second. So I'm going to start, actually, this is the 5 things to start your day that is from the European session, okay? So just if you are on live, can you just type in the chat you can hear me okay, right? Please, just someone, because I have had those issues with the mic. So I hope these are good. But I'm going to start off with the European. And so we're talking about Russia and the G7, nothing to really impact us. But this isn't in the actual US version in here. So looking back to yesterday, so McCarthy yesterday stoked optimism yesterday that things were. You can hear me. Oh, thank you, RMG. So so McCarthy stoking optimism that we are going to get probably something going to become through on the debt limits deal. Probably, maybe not over the weekend, potentially going into next week. Biden has flown out. That's kind of seen as a positive sign. He's flown out to G7, despite all this going on with regarding the debt ceiling. So clearly moving ahead. And then also in here, look, negotiations narrowed to top staffers for McCarthy and Biden here. So that's a positive as well, right? So they only escalate it up the hierarchy, as it were, when they're making progress. So that's seen as a positive. So all of that. So making plans, and McCarthy and Chuck Schumer in here apparently making plans for votes in the coming days on the deal. Okay, so that looks like it's all positive. And we saw that in the price action yesterday, right? Big breakout eventually. I mean, NASDAQ's been rallying anyway to new multi-month highs, but finally we got the breakout, not just from the 1 to 2 week range, but from the bigger range by the S&P, and also making multi-month highs on the S&P. So the broader market following the big tech, but following the growth stocks higher in here, breaking out to the upside on these hopes in here. And then also in here, this is also not picked up on the US version, but yesterday, despite all that, as I said in here, we had comments in here out of Laurie Logan, and also Bostic. Now, Bostic, if we go back to the Hawk Dove sheet in here, Bostic on our Hawk Dove sheet is very much, where is Bostic in here? We actually got him in here, but he's very much of a dove in here. We've got him more in the middle in here, but also sitting alongside Bostic. If I go back, we had Laurie Logan in here. Okay, Laurie Logan speaking. And if again we go back to the Hawk Dove sheet in here, where's Logan? Logan. It sits up here as more of a dove, right? So Logan sits more of a dove. Bostic is kind of quite dovish, you know. I mean, this data is all courtesy of ITC Markets, okay, In Touch Capital Markets. But yeah, I mean, I think Bostic, you know, is fairly comes through as mostly more of a dove. I think he's probably more of a dove up here a little bit more. But both Logan and Bostic certainly more on the dovish side. And their comments, you know, Bostic certainly, look, he's been very dovish, saying, he was talking about the pools before we went to the last rate hike. Also said that not moving in June wouldn't necessarily mean that the Fed was done raising rates. Okay, so that's kind of hawkish. We're kind of seeing this as pause and done, and they're looking for cuts. That's certainly what the market was looking for anyway. And then even probably more aggressive in here, Logan. So Logan says that she's not ready to call a halt to the Fed's tightening campaign and floated an option to skip action next month. So what they're talking about is in here pause, but keeping the door open to restarting. So it's a skip rather than us pause and stopping, right? And that's kind of highlighted in these articles in here. Oh, no, not that one there. Where are we? Over here, I think. Fed officials consider skipping a hike in June, but don't call it a pause. So they're talking about it as a skip. So skip means like skip, don't hike at this time, but then hike the next time, okay? So that's coming through from both Logan and Bostic yesterday. So that certainly in here is keeping the door open to further rate hikes, okay, which we weren't really considering. We were looking for pause and done, and then rate cuts coming into the second half of the year. That's what the CME tool was pricing. And if we go and look at the CME tool now, what's it showing us? If we go back in here to June, okay, so now we're getting close to 50-50 to a rate hike now, right? This was up in the 80s and 90s last week, okay, that we were going to be done, okay? Now we're like almost 50-50. Well, we're 60-40, right? But very close. This has moved since this morning. This was up in the 60s when I was looking this morning, okay? So already it's dipped below the 60 level in here. This was more like 65-35 only a few hours ago. So we're solidly moving towards potential for a rate hike at the next meeting. And if we go to July in here, July a little bit sort of in here even more so, okay? So what we got in here, 57%, and by July certainly in the next two meetings I'm looking for a potential hike coming through in here still, okay? And then if we look at September, remember September, November, December we were looking for cut. We'll look at September now, no cut, okay? And then November, first cut, one cut, and then December, maybe a second cut, but maybe not a second cut. It's kind of even Stevens between now. Maybe pricing in 475 to 500 at year end. This was pricing in at year end. This was the biggest chance here, 425 to 450, only 3-4 days ago. Okay, we were looking for 3 rate cuts. Now we're almost looking for only 1 by year end. Okay, so the market has shifted. We said this would happen, that either the Fed would move slightly more dovish, or the market would have to move slightly more hawkish to accommodate. You know, they both can't be right. The Fed has to say, but then the Fed's going to send us different messages. Okay, so certainly the messages over the past literally 24 hours, really over the last week, and this, remember, is all going on in the last 48 hours with stocks breaking out to the upside. This normally, in normal scenario, this will be taken as a negative. Okay, what I think it's done is that the debt ceiling, the lack of concerns about the debt ceiling in here, then means that it's more likely that the Fed stays the course and is less dovish. Okay, if we get the debt ceiling sorted out, the Fed, if we didn't raise the debt ceiling and there was a default, then the Fed are probably going to be cutting rates, okay, more aggressively. So it's partly to do with that, but it's also partly to do with the rhetoric that's been coming out of the Fed speakers. And as I just said in here, 3 more of those today, 3 different speakers as well. Williams, Bowman, and Powell. Okay, so certainly we need to have all of that on the radar going into today, given these quite aggressive moves we've had here over the last 24 hours across the rate curve. Okay, so we're watching that going into today, and also any further news on the debt ceiling. Okay, so we've got that in here, Fed skip, and then also China. China's been very negative. Okay, very negative on China. So if I go and take a look, where I've got some articles in here, Chinese stocks here. China faces confidence trap as economic recovery falters. Alibaba was posted negatives in here overnight in here. If you go and take a look at the, I'm going to just quickly bring up, what can I bring up to show you in here? I'll show you the well, let me see if I can get a Hang Seng chart up. So the Hang Seng, obviously the Chinese index in here. If we look at the Hang Seng index in here, Hang Seng index chart. Okay, let me just do it this way. Let me see if I can here. I'm just going to go here. Just the first one that I come across. I just want to show you the Hang Seng, just to show you how much it's moving in the opposite direction more than anything else. In here, can we do it as a candlestick chart? Yeah, we can. Okay, there you go. Look, so it's been drifting lower. Okay, we've been sideways on the S&P, but look at it in here. This is the last few days, breaking down to the downside. So negatives coming out of China in it. So what the reason I'm showing you this, and I know kind of you guys might be, I don't care, I want to trade the ES, I want to trade the NQ. I want to point out in here that we've had, okay, this is how overriding the positive news is, and how powerful the breakout was yesterday, even more powerful, because we did it in the face of effectively kind of hawkish comments from Fed speakers, okay, from the fact that those hawkish comments saw a big shift in the interest rate curve, which should be against the equity markets, should be negative for the equity markets, a big shift to more hawkish from the equity curve and from the Fed speakers, and Chinese stocks in here and Chinese data this week pushing the Chinese markets lower, okay? And that's the second biggest economy in the world, right? So all of that, okay, all of that in here has pushed markets in here, has not allowed has been in the face of markets breaking out to the upside. So it shows you how powerful, even more powerful that move was. Not only yesterday, but we set it up the day before. Okay, 5 things to start your day. This is the American version in here. Joe Biden, he's in Japan on the G7 summit. Okay, he's a negotiating team over a call early Friday. He's confident Congress will act in time to prevent a US debt fault limit. So that's all looking good. US and Taiwan have agreed to boost trade ties. OpenAI is bringing ChatGPT to smartphones. Blah, 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 blah. Nothing really that interesting. The stuff was more interesting in the European version this morning. And what does it mean in here? Well, you know what? Nikkei, the Japanese stock index. Now, the Japanese, we spoke, I think, earlier in the week or the end of last week, earlier in the week, the topics, that's one of the Japanese stock index, hit a new high. It went back to the 1990s high, all-time high. It hasn't been at that level since 1990. And the Nikkei, which is the real benchmark in here, where are we? Japan's Nikkei powers to 1990 bubble era high. So the Nikkei also hitting a new high. And if we go back to this one here, DAX nears its record. The DAX is the German index, nearing its record high. So European stocks all pushing higher in here, all on the back of this the fact that we had the hopes around the debt ceiling, really, and that's in the face of, look, Treasury stabilized after sell-off, so on rate paused out. Okay, so Treasury saw a significant move lower. Jumping to the charts in here, let's park those in here. So we go to the charts, we go look at the Treasuries, 10-year, big push lower. Look, Treasuries have been tumbling down in price, up in yields up in here. We took out this low in here. You've got a triple top pattern, 1, 2, 3. This is all very negative, right? This is negative, saying, okay, higher yields should be negative for stocks. Okay, lower prices equals higher yields. This should all be negative for stocks. I just want to really reinforcing how significant the breakout was yesterday, because it was in the face of relatively hawkish Fed, the short end, the interest rate curve moving to a more hawkish position, a more restrictive position, and the long end also here, the 10-year selling off, going to multi-week, in fact, multi-month higher yields, highest yields since the end of March. Okay, so all of that, okay, in the face of all of that, and in the face of Chinese stocks, second largest economy in the world, going lower, Alibaba going lower, all of that, in spite of all that, stocks still pushing higher, and the US stock index taking the Nikkei to its highest level for decades, and also taking the DAX, the German index, close to record levels. So I just want to reiterate again how forceful the move was. What else do we have? Here's how the debt limit deal is looking at talks go down to the wire. Well, are they down to the wire? The wire is apparently another 2 weeks away. It looks like they're going to get solved. Fed's power in the spotlight. So I think it is going to be as pressure grows to fish or cut bait, okay, on rates in here. So again in here, looking to any more clues after that kind of step we had. G7, Zelensky apparently. I don't think that's going to make a big difference. USD debt ceiling deal. So this is interesting. So this analysis here, I'm going to share this one in the chat. This here basically saying we've had a big outperformance by NASDAQ, right? We've had a big outperformance by growth stocks, by the big mega cap tech, okay, has driven this rally, okay, pre the breakout even yesterday, okay. We know that NASDAQ's been hitting new highs. S&P hasn't been doing that. So it's been driven by the mega cap tech stocks in here. But and they do make up a big part of the S&P, but the broader index hasn't managed to break out. This article in here is talking about, okay, once the debt ceiling deal is done, it could be a buy the rumor, sell the fact. So buy the rumor, sell the fact. Now would therefore mean underperformance by tech. So we could see the S&P start to lead where the NASDAQ has been previously trying to lead, and see underperformance from the NASDAQ. That's what this article is arguing. Fed visuals consider skipping. We've already looked at that. Fed's Logan doesn't yet see case for June pulls. We've dealt with that. DAX, we've dealt with that. Alibaba, China. We've all dealt with that. And just incidentally, this is by the by, but the yen has been weakening more recent, despite actually stronger than anticipated inflation data from Japan overnight. The yen continues to weaken, and that's helping the Japanese stock market go higher. And oil doing well over all this week in here as we go back into that risk on move. That risk on move in here that we're seeing in stocks, helping oil push higher too. Quick nod to the charts. I'm not going to spend too much time in here. So triple top pattern there, 1, 2, 3 highs. Triple top pattern confirmed yesterday on treasuries. They look very, very vulnerable going into today. While I'm on this tab, let's look at gold. Gold also, as we've seen dollar strength, the dollar has gone higher. So we've seen obviously in here lower treasury prices. We've seen yields higher, the interest rate curve higher, assisting the dollar higher. So the dollar's been pushing higher. That's been a negative for gold. Gold took out, we looked at this yesterday, took out these supports in here, gathered around 1780. Also took out supports around 1766. Now risk down through this little low in here at 1953.7. Down through there would see even worse performance from gold. And if we take a look at oil, despite the little dip yesterday, and then a bounce this morning after we saw that impulsive move higher 2 days ago on Wednesday, this looks like we could easily be heading up to that little peak there on oil, which is 73.89 and maybe above today. So if we stay in risk on, looking for oil to move to the 74 handle potentially. A quick nod onto stocks in here, but all I'm going to say is bullish. I cannot be anything other than, if you're trying to fight this, don't fight it. Two very big impulsive candlesticks. Who's going home short this weekend, right, when the deal is likely to be done, right? Probably no one. The S&P took out that peak there, now honing in on these peaks. We could easily see up to that peak there from February. That's the high of the year. That high there is 42.44. I think we could have a go at that today, okay, on the S&P. And you look at the 30-minute chart in here, high-level consolidation, high-level flag yesterday. We looked at this previously. Flag, consolidation. It looks like it wants to break right now, okay? And it's no different really on the NASDAQ, okay? But the NASDAQ's been going longer. Up. A little bit of a dip back lower here on the NASDAQ, but again, it's relatively high-level consolidation. A little bit of a flag back lower, probably looking to wait to break back above like 13,935 before I would think about long there. But you might start seeing the little bit of leadership switch to the S&P away from the NASDAQ. So maybe looking at that little counter trend line that we have running across there for the NASDAQ, that one there, okay, and we're sitting right on there, up through 13, I think 9, well, that peak there, the overnight, 13,931.75, up through there, looks more bullish again. I'm going to leave it there, guys. Any questions? No? All right, guys, I'm going to wrap it there. Have a great trading day. Have a great weekend. I'll be back with you another bull versus bear webinar tomorrow. Take care. Bye.